The world of finance is on high alert as Ray Dalio, one of the most respected financial experts, predicts a crisis just around the corner. With the U.S. national debt surging past an alarming $34 trillion as of January 2024, what does this mean for our financial future? Are we on the brink of a financial collapse, or is there still time to avert disaster? In this video, we'll look deeply into Dalio's predictions, uncover the critical signs he warns about, and explore how they could impact everything from stocks to real estate. But that's not all. Stay with me until the end, where I will show you practical steps to protect your investments and get through the potential financial crisis. Ray Dalio, the founder of Bridgewater Associates, one of the world's largest hedge funds, has a track record of accurate economic predictions. Recently, Dalio has been vocal about a looming debt crisis in the United States. His insights are not based on mere speculation, but are grounded in comprehensive economic analysis and historical patterns. As of January 2024, the U.S. national debt has surged past $34 trillion, a staggering figure that represents more than 125% of the country's GDP. This level of debt is not just a financial burden, it poses a significant risk to the nation's economic stability. Dalio's primary concern is the sustainability of this debt. He emphasizes that the issue is not just the size of the debt, but the increasing difficulty in servicing it. Currently, the U.S. spends $169 billion annually on interest payments alone, which accounts for about 16% of the federal budget. This is money that could otherwise be spent on essential services like education, healthcare, and infrastructure. As interest rates rise, these payments will become even more burdensome, potentially leading to severe cuts in other areas of government spending. The real danger lies in the potential for debt spiral. A debt spiral occurs when a country has to borrow more money to pay off existing debt, leading to higher interest rates and an unsustainable financial situation. Dalio warns that the U.S. is perilously close to entering such a spiral. The government's reliance on borrowing to cover its expenses is growing, and as the debt increases, so does the interest burden. If this trend continues, the country could face a financial crisis that would ripple through the global economy. To understand the severity of Dalio's predictions, it's essential to look at the historical context of debt crises. Debt has been a constant companion of the United States since its inception. During the Revolutionary War, the U.S. accumulated significant debt, and this trend continued through various conflicts and economic challenges. However, the current debt situation is unprecedented in its scale and potential impact. The concept of a debt spiral is not new. Historical examples are abound of nations that fell into this trap and suffered catastrophic consequences. For example, in the early 20th century, Germany's Weimar Republic experienced hyperinflation and economic collapse due to its inability to manage war debts and reparations. More recently, Greece faced a severe debt crisis in the late 2000s, leading to austerity measures and economic hardship for its citizens. Dalio draws parallels between these historical examples and the current U.S. situation. He points out that the U.S. has always managed to find ways to navigate its debt challenges, but the current levels of debt, combined with the global economic context, make this challenge much more daunting. The U.S. debt to GDP ratio is now higher than it was at the end of World War II, a time when the country was emerging from a global conflict and had the advantage of being the world's leading industrial power. However, the global economic landscape has changed significantly since then. The U.S. is no longer the sole economic superpower, and its debt is held by a diverse group of international investors, including foreign governments. This diversification of debt holders adds another layer of complexity to the situation, making it more difficult to manage and stabilize the national debt. One of the critical components of Dalio's predictions is the supply-demand gap in government debt. The U.S. government issues Treasury securities, such as bills, notes, and bonds, to borrow money from investors. These securities are essentially promises to repay the borrowed amount with interest over a specified period. Historically, these instruments have been seen as safe investments, attracting a wide range of buyers, from individual investors to large financial institutions and foreign governments. However, Dalio warns that there is a growing shortage of buyers for these securities. Several factors contribute to this decline in demand. Geopolitical tensions, such as trade disputes and economic sanctions, have made foreign governments weary of holding large amounts of U.S. debt. Additionally, changes in global investment patterns mean that large institutional investors are seeking higher returns elsewhere. The U.S. Federal Reserve has also been a significant buyer of government debt, particularly during periods of economic crisis. However, the Fed has indicated that it will taper its bond buying programs, reducing the artificial demand for Treasury securities. This shift could exacerbate the supply-demand gap, forcing the government to offer higher interest rates to attract buyers. Dalio explains that this supply-demand issue could lead to a classic late-cycle debt crisis. When there are more sellers of debt than buyers, interest rates must rise to make the securities more attractive. However, higher interest rates increase the cost of servicing the debt, creating a vicious cycle where the government has to borrow more at higher costs, leading to further economic instability. Rising interest rates are a central concern in Dalio's predictions. Higher interest rates make it more expensive for the government to service its debt, increasing the financial burden on the federal budget. But the impact of rising interest rates extends beyond government debt. It affects the entire economy. When interest rates rise, borrowing costs increase for businesses and consumers. This can lead to reduced investment and spending, slowing down economic growth. For example, higher mortgage rates can make it more expensive to buy homes, leading to a showdown in the real estate market. Similarly, higher rates can discourage businesses from taking out loans to expand operations or invest in new projects. Dalio points out that the current low-interest rate environment has fueled a significant economic growth and asset price inflation. However, this growth has been built on a foundation of cheap debt. As interest rates rise, the cost of servicing this debt increases, potentially leading to defaults and bankruptcies. This is particularly concerning for high-leveraged sectors, such as real estate and corporate debt. Moreover, rising interest rates can lead to a stronger dollar, making U.S. exports more expensive and less competitive on the global market. This can further slow down economic growth and exacerbate trade deficits. The combination of these factors creates a precarious economic situation where rising interest rates could trigger a broad-based economic downturn. Dalio's warning is clear. If interest rates continue to rise to attract buyers for government debt, the broader economy could suffer. The interconnected nature of the financial system means that a crisis in one area can quickly spread to others, leading to a systemic crisis that could rival or surpass the 2008 financial crisis. In addition to economic factors, Dalio highlights the role of geopolitical and internal conflicts in exacerbating the debt crisis. Geopolitical tensions, such as trade wars and sanctions, can disrupt global investment patterns and increase economic uncertainty. For example, ongoing trade disputes between the U.S. and China have led to fluctuations in global markets and shifts in investment strategies. Furthermore, internal conflicts within the U.S. contribute to economic instability. Political polarization and wealth inequality have created a fragmented social landscape. Dalio points out that economic instability often coincides with political turmoil, leading to a chain reaction where each issue impacts the other. Political polarization can lead to policy gridlock, making it difficult for the government to implement effective economic policies. This is particularly concerning in times of crisis, when decisive action is needed to stabilize the economy. The growing wealth gap also contributes to social unrest and populism, further complicating the political landscape. Dalio warns that these conflicts can lead to the rise of populist leaders who prioritize short-term gains over long-term stability. Populist policies such as protectionism and fiscal irresponsibility can exacerbate economic problems and lead to further instability. The combination of economic, geopolitical, and internal conflicts creates a complex and volatile environment that makes managing the debt crisis even more challenging. While Dalio's predictions are alarming, history provides some reassurance. The U.S. has faced significant debt challenges before and managed to navigate through them. For example, after the Civil War, the national debt skyrocketed by a staggering 40 times. Despite these challenges, the U.S. successfully stabilized its economy through prudent fiscal policies and economic growth. One of the key lessons from history is the importance of responsible fiscal management. During times of economic stress, governments must balance the need for stimulus with the necessity of maintaining fiscal discipline. This means implementing policies that promote economic growth while keeping debt levels sustainable. Dalio emphasizes that the U.S. has several unique advantages that can help manage the current debt situation. As the world's largest economy and a global financial leader, the U.S. has a significant degree of economic resilience. The widespread use of the U.S. dollar in international trade provides additional stability, as the high demand for dollars supports its value and mitigates the inflationary pressures. Moreover, the U.S. has a diverse and innovative economy, with robust financial institutions and a strong regulatory network. These factors provide a buffer against economic shocks and create a foundation for sustainable growth. However, Dalio warns that relying solely on these advantages without addressing the underlying debt issues could lead to complacency and complicate the crisis. To navigate through the current debt challenges, Dalio suggests several potential solutions. First, the government must implement policies that promote economic growth while maintaining fiscal discipline. This includes investing in infrastructure, education, and technology to boost productivity and create sustainable economic growth. Second, the government must address the supply-demand gap in government debt by creating a more favorable investment environment. This could involve offering more attractive terms for Treasury securities or implementing the policies that increase demand for U.S. debt. Third, policymakers must work to reduce political polarization and promote social cohesion. This involves addressing wealth inequality, improving access to education and healthcare, and fostering a more inclusive economic environment. By reducing internal conflicts, the government can create a more sustainable and resilient economy. Now let's talk about how you can protect your investments in this current economy. Given the complex and potentially volatile economic landscape outlined by Ray Dalio, it's important to consider practical steps to protect your investments. Diversification is one of the most effective strategies in this regard. By spreading investments across various asset classes, such as stocks, bonds, real estate, and commodities, you can mitigate risks. For example, if one sector suffers due to rising interest rates, others might still perform well, balancing out potential losses. Another critical approach is focusing on quality investments. In uncertain times, investing in companies with strong balance sheets, consistent cash flows, and a history of weathering economic downturns can provide a safety net. These companies are more likely to survive and even thrive during economic challenges, offering a level of stability to your portfolio. Maintaining healthy cash reserves is also essential. Cash provides liquidity, allowing you to take advantage of investment opportunities that may arise during economic downturns. It also offers a buffer in case of emergencies, ensuring you are not forced to sell assets at a loss to cover unexpected expenses. Considering inflation-protected securities, such as Treasury inflation-protected securities or TIPS, can help safeguard your investments from eroding effects of inflation. These securities adjust their principal value based on inflation, ensuring your investments maintain their purchasing power over time. This is particularly important in an environment where rising interest rates might lead to higher inflation. Staying informed and being adaptable is vital. Keeping up with the economic trends and developments allows you to adjust your investment strategy as needed. Regularly reviewing and adjusting your portfolio ensures it aligns with your financial goals and risk tolerance, helping you navigate through potential economic turmoil effectively. As we conclude, it's clear that Ray Dalio's predictions highlight significant challenges for the U.S. economy. The growing national debt, the supply-demand gap in government debt, rising interest rates, and geopolitical and internal conflicts all point towards a potential crisis. However, history shows that with prudent fiscal management and strategic policy implementation, it is possible to navigate through these challenges. So what do you think? Are we heading towards a financial collapse, or can we turn things around with the right strategies? Let me know in the comments below. And don't forget to like and subscribe for more insights on the financial world.